Ray Dalio manages $150 billion, but the portfolio he's most proud of wasn't designed for billionaires. It was designed for people who couldn't afford to lose. If you're over 60, this is the strategy he built specifically for you. 1996. Bridgewater Associates headquarters in Westport, Connecticut. Ray Dalio's sitting across from a new client, someone who just handed him their entire retirement savings. They're 63 years old. They can't afford Ray's flagship Pure Alpha fund. The risk is too high. The volatility would give them a heart attack. The client asks a simple question: can you build me something that just works? I don't need to beat the market. I just need to not lose everything when the next crash comes. Ray looks at them. He's been running Pure Alpha for 5 years. It's making 12 to 15% annually. It's brilliant, but this person doesn't need brilliance. They need safety. They need predictability. They need something that works when they're 75 and can't go back to work. So Ray goes back to his office. He starts sketching. Not another hedge fund strategy, something different. A portfolio built backwards. Instead of asking, how do I maximize returns, he asks a completely different question: how do I build something that survives every possible economic environment? That question led to the all-weather portfolio. And it's probably the most important thing Ray Dalio ever created. Because unlike Pure Alpha, which requires millions to access, all-weather is something anyone can replicate, including you. Okay, so here's what I want to talk about today. Most people think Ray Dalio is all about maximum returns, aggressive hedge fund strategies, making as much money as humanly possible. And yeah, Pure Alpha, his flagship fund, does that. But there's this other side of Ray that nobody talks about. The side that looked at retirement and said, you know what? Most people are doing this completely wrong. If you're over 60, or even if you're approaching 60, everything you've been told about investing is probably backwards. And I'm not being dramatic. I spent the last week deep diving into how Ray thinks about retirement portfolios, and honestly, it completely changed how I see this phase of life. Let me take you back to 1996. Ray's already successful. Bridgewater is managing billions. Pure Alpha is crushing it, but he keeps getting these clients who can't handle Pure Alpha's volatility. They're older, they're retired or close to it. They've got their life savings and they need it to last another 30 years. They can't afford a bad decade. And Ray realizes something. The entire investment industry is built for young people. Growth stocks, maximum returns, ride out the volatility. But when you're 65 and the market crashes 40%, you don't have time to wait 15 years for it to recover. You need your money now, you need income now, you need safety now. So Ray asks himself this question, and I love this question because it's so simple but nobody was asking it. What if I built a portfolio that worked in every economic environment, not just bull markets, not just when the Fed is cutting rates, every single environment? He calls it the all-weather portfolio, and here's what makes it genius. Ray doesn't start with stocks or bonds or gold. He starts with economics. He maps out every possible economic scenario. There are 4 basic combinations. You've got rising growth with rising inflation, that's a boom. You've got rising growth with falling inflation, that's the Goldilocks scenario everyone loves. You've got falling growth with rising inflation, that's stagflation, the nightmare of the 1970s. And you've got falling growth with falling inflation, that's deflation, the Great Depression scenario. 4 seasons, 4 possible economic environments, and here's the thing. Nobody knows which season we're going to be in next year. The Fed doesn't know, the economists don't know, Ray Dalio doesn't know, so instead of trying to predict it, he builds a portfolio that performs reasonably well in all 4. Think about that for a second. Every traditional portfolio is making a bet. If you're all in on stocks, you're betting on rising growth. If you're heavy in bonds, you're betting on falling growth or falling inflation. If you're in gold, you're betting on inflation or crisis. But all-weather, it's not betting on anything, it's hedging everything. Now let me break down the actual allocation because this is where it gets really interesting. The all-weather portfolio that Ray designed looks like this. 30% in stocks, that's way less than most people have. If you go to a traditional financial advisor, they'll tell you something like 60% stocks, 40% bonds if you're 60 years old. Ray says no, 30% stocks is enough to capture growth. More than that and you're taking unnecessary risk. Then you've got bonds. This is where people get confused. Ray puts 40% in long-term bonds. We're talking 20 to 30-year treasury bonds. Another 15% goes in intermediate-term bonds, 7 to 10 years. So combined, that's 55% of your portfolio in bonds. That sounds crazy conservative to most people, but here's why it works. Bonds do well in 2 of the 4 economic seasons. When growth is falling or when inflation is falling, bonds go up. They're your insurance policy against recession and deflation. Now here's the part that makes this different from every other retirement portfolio you've ever seen. 7.5% in gold, another 7.5% in commodities. That's 15% combined in real assets. Most retirement portfolios have 0 gold, 0 commodity. They're completely exposed to inflation risk. But Ray looked at the 1970s when inflation hit 15% and stocks did nothing for a decade, and he said, never again. Gold is your hedge against inflation and currency devaluation. Commodities do well when growth is rising and inflation is rising. They complete the picture. So you added up 30% stocks, 55% bonds, 7.5% gold, 7.5% commodity. That's the all-weather portfolio. And the return about 7 to 8% annually over the long term. Not exciting, not going to make you rich quick, but here's what matters. It delivers that 7 to 8% consistently through crashes, through inflation spikes, through every crisis since 1996. I want you to really think about what 7% means when you're over 60. If you've got $500,000 saved, a realistic number for a lot of people approaching retirement, 7% annual return is $35,000 a year. You can live on that. You can supplement Social Security with that, and you're not touching the principal. Your 500,000 stays 500,000, growing at 7% while you live on the gains. Compare that to the alternative. Let's say you go aggressive, all stocks. You're chasing 10 or 12% returns, great when it works, but 2008 happens. Your 500,000 drops to 300,000. Now you're 67 years old and you just lost $200,000. You're panicking. You sell at the bottom because you can't afford to lose more. And now you're living on Social Security alone, watching your friends who stayed diversified recover while you're permanently impaired. That's the nightmare scenario Ray built all-weather to prevent. And get this. During 2008, when the S&P 500 crashed 37%, the all-weather portfolio, it was roughly flat. Some versions were down 5 to 8%. Some were actually positive, but nothing close to 37%. If you were 70 years old in 2008 with all-weather, you slept fine. You didn't panic. You didn't sell. You just rebalanced and moved on. Here's where the pattern emerges. Ray didn't invent this portfolio in a vacuum. This comes directly from his 1982 failure. Remember, Ray predicted a depression in 1982. He was catastrophically wrong. The market rallied. He almost went bankrupt. And that failure taught him something critical. You cannot predict the future. You can only prepare for multiple possible futures. That's what all-weather does. It's not predicting. It's preparing. It's saying, I don't know if we're going into inflation or deflation, boom or bust, so I'm going to own assets that do well in each scenario. And I'm going to weight them by risk, not by dollar amount. This is the risk parity concept that Bridgewater is famous for. Most people think diversification means owning 100 different stocks. But if all those stocks are in the S&P 500, they're all correlated. They all go down together in a crash. That's not diversification. That's concentration disguised as diversification. Real diversification means owning assets that move independently. Stocks, bonds, gold, and commodities are genuinely uncorrelated. When one is down, another is usually up. That's the whole point. Now I want to address something because I know some of you are thinking 7%. That's it, I can get 12% in an index fund, and you're right. Over the very long term, stocks average 10 to 12%. But here's the thing. When you're over 60, you're not investing for the very long term anymore. You're investing for the next 20 to 30 years, and you need that money along the way. You can't afford a lost decade. Between 2000 and 2009, the S&P 500 returned negative 1% annually. If you retired in 2000 with $1 million all in stocks and you were taking out $50,000 a year to live on, you were completely screwed. Your million turned into $600,000 by 2009, and you'd already withdrawn $450,000, so you're running out of money at 75. But if you had all weather, you were fine. You made 7% most years. You took your $50,000, you rebalanced. You're still sitting on $800,000 at 75, and you're going to be fine until 90. Let me tell you what Ray actually said about this. In his interview with Tony Robbins for the book Money, Master the Game, Ray explains that all weather isn't about getting rich. It's about not getting poor. It's about staying in the game. Because in investing, if you stay in the game long enough without blowing up, compound interest does the work. Here's the math that blew my mind. If you're 62 years old with $500,000 and you can generate 7% annually, you can withdraw $35,000 a year and never touch the principal. But most people don't do that. They panic during crashes. They sell low. They buy high. They destroy their own returns through emotional decisions. All weather removes the emotion. The portfolio is designed so that no matter what happens in the economy, you're okay. Stocks crash, your bonds are up. Inflation spikes, your gold and commodities are up. Deflation hits, your long-term bonds are soaring, you're covered, so you never panic, you never sell at the bottom. You just rebalance once or twice a year and keep going. Now here's something critical about rebalancing, because this is where the returns actually come from. Let's say stocks have a great year and they go from 30% of your portfolio to 40%. You rebalance, you sell some stocks, buy some bonds or gold to get back to 30%. You just sold high, then stocks crash, now they're 20% of your portfolio. You rebalance again, you sell some bonds, buy some stocks, you just bought low. You're systematically buying low and selling high without trying to time anything. The rebalancing does it automatically. Ray has this principle in his book, Pain plus Reflection equals Progress. That came from 1982. The pain of being wrong about the depression, the reflection of figuring out why he was wrong, and the progress of building systematic approaches that don't depend on being right about the future. All weather is that principle in action. Ray can't predict the future, you can't predict the future, I can't predict the future, but we can build a portfolio that works regardless of the future. That's the insight. And honestly, this completely shifted my understanding of retirement investing. I used to think retirement was about playing it safe, being conservative, accepting lower returns. But that's not what Ray's doing. He's not being conservative. He's being systematic. He's being intelligent about risk. There's a huge difference. Conservative investing is keeping everything in cash or CDs earning 2% while inflation is 3%. You're getting poorer every year. That's not safe. That's guaranteed loss of purchasing power. What Ray's doing is saying, I'm going to own risky assets, stocks, long-term bonds, gold, commodities, but I'm going to balance them so the portfolio as a whole isn't risky. The whole is less risky than any individual part. It's like building a bridge. Each beam individually might be weak, but when you structure them correctly, the bridge is incredibly strong. That's what all weather does with asset classes. Now let's talk about the specific numbers you need to make this work, because I think this is where it gets really practical. Ray's talking to institutional investors managing billions, but the concept scales down perfectly to regular retirement accounts. If you need $40,000 a year to live on in retirement, a pretty typical number, you need somewhere between $520,000 and $560,000 to generate that at 7 to 8%. That's your target. If you've got that saved by 60 or 65, you can implement all weather and you're probably going to be fine for the rest of your life. If you've got less than that, you need to either save more, work longer, or reduce your annual spending needs. The math is unforgiving, but at least with all weather, you know the math is reliable. You're not hopping for a miracle 20% year that might never come. And here's what I found really interesting. Ray designed this in 1996. It's been running for almost 30 years now. It's been through the dot-com crash, the 2008 financial crisis, the COVID crash in 2020, the inflation spike in 2022 and 2023. Every single time it did what it was supposed to do. It didn't crash, it didn't blow up. It delivered steady, boring, reliable returns. Boring is good when you're over 60. Boring means you sleep at night. Boring means you don't panic sell at the bottom. Boring means you can actually enjoy retirement instead of obsessively checking your portfolio every day. I also want to talk about what this looks like in practice, because the allocation percentages are one thing, but implementing them is another. You can do this with index funds. You don't need Bridgewater. You don't need millions of dollars. You can buy a total stock market index fund for the 30% stocks. You can buy long-term treasury bond funds for the 40% long bonds, intermediate treasury funds for the 15%. A gold ETF for the 7.5% gold, a commodity index fund for the 7.5% commodities. 5 positions, that's it. You can set this up in a single afternoon, and then twice a year you rebalance. If anything is more than 5 percentage points off target, you sell some and buy some of what's low. Takes 15 minutes, that's the entire maintenance. Compare that to trying to pick individual stocks or timing the market or following some complicated trading strategy. All weather is almost stupidly simple, but simple doesn't mean easy. The hard part is sticking with it when stocks are going crazy and you're only 30% invested and you feel like you're missing out. That happened in the late 1990s. Stocks were up 20–30% a year. All weather was making 7–8%. People felt stupid. They abandoned it. They went all in on tech stocks, and then March 2000 happened and they lost everything. Ray's genius was understanding that the hardest part of investing isn't building the right portfolio. It's staying in the right portfolio when it feels wrong. All weather feels wrong pretty often. When stocks are soaring, it feels too conservative. When bonds are soaring, it feels like you should have more bonds. When gold is soaring, it feels like you should have more gold. But the whole point is that you never know which one is going to soar next, so you own all of them all the time. There's this quote from Ray's Principles book that I keep coming back to: "He who lives by the crystal ball will eat shattered glass." That's what he learned in 1982. Trying to predict the future is how you blow up. Building systems that work in multiple futures is how you survive and compound. And compounding is everything when you're over 60, because you don't have 40 years anymore. You've got 20, maybe 30 years. But here's the thing. If you start at 60 with $500,000 and you compound at 7% for 20 years while withdrawing $35,000 annually, you actually end up with more money at 80 than you started with at 60. The math works. Compounding plus disciplined withdrawals equals sustainability. That's the promise of all weather, not that you'll get rich, but that you won't get poor, that you'll have enough, that your money will last as long as you do. And honestly, for most people over 60, that's the whole game. You're not trying to build a billion-dollar fortune. You're trying to maintain independence, maintain dignity, maintain the ability to live your life without financial stress. Ray gets that. He built pure alpha for the people who want maximum returns and can handle the volatility. He built all weather for everyone else, for the people who just need it to work. Now I want to address one more thing before we wrap up, because I know some of you are thinking about the current environment. We're in 2025. Inflation has been weird. The Fed has been raising and lowering rates. Stocks have been volatile. Does all weather still work? And the answer is yes, because all weather wasn't built for a specific environment. It was built for all environments. When inflation spiked in 2022, the gold and commodities in all weather offset the losses in stocks and bonds. When the Fed started cutting rates, the bonds did well. The portfolio balanced itself. That's the whole point. You're never going to have the best performing asset class, but you're never going to have the worst performing portfolio. You're always somewhere in the middle, making reasonable returns, staying in the game. And staying in the game is how you win in retirement, because the alternative, trying to time the market, chasing returns, making big bets, that's how you lose everything and can't recover. Ray Dalio is worth about $15 billion. Bridgewater manages $150 billion, but when he talks about all weather, he doesn't talk about getting rich. He talks about being prepared. He talks about survival. He talks about the lessons from 1982, when he learned that being certain about the future is the most dangerous thing you can do. All weather is the opposite of certainty. It's humility in portfolio form. It's saying, I don't know what's coming, so I'm going to be ready for anything. So here's what I want you to take away from this. If you're over 60 or approaching 60, your investment strategy needs to change. Not because you're old, not because you're conservative, but because your time horizon is different and your risk tolerance should be different. You can't afford a lost decade. You can't afford to panic sell at the bottom. You need something that just works. That's what Ray built with all weather, 7 to 8% annually through every crisis, with dramatically lower volatility than stocks alone. It's not exciting. It's not going to make you a billionaire, but it's going to let you sleep at night. It's going to let you enjoy retirement without constantly worrying about money. And honestly, that's worth more than chasing an extra 2% return. Now I want to hear from you. Are you currently over 60 or are you planning for retirement? How are you thinking about portfolio allocation? Are you all in on stocks or are you already diversified across asset classes? Drop a comment below. I'm genuinely curious how people are approaching this. If you found this valuable, hit that like button and subscribe. We're releasing new Ray Dalio deep dives regularly, and you don't want to miss them. I'm your host. This is legendary investor Ray Dalio, and I'll see you in the next one.